Did you know that if you invested $1,000 in Amazon when it went public in 1997, it would be worth over $1.5 million today? Shocking, right? Investing can seem like a mystery, but the right books can unlock the secrets of the market. Whether you're just starting out or looking to sharpen your skills, these top 6 investment books for beginners are your ticket to financial success. In this video, we'll explore each book's unique strategies and insights. From Mastering the Art of Value Investing with Benjamin Graham to Understanding the Randomness of the Stock Market with Burton Malkiel, each chapter offers something special. You'll learn how to pick stocks like Peter Lynch, use Joel Greenblatt's magic formula, and even dive into the world of bonds with Annette Thau. Plus, discover Philip Fisher's timeless techniques for spotting high-growth companies. Ready to turn the page on your financial future? Let's get started. Chapter 1. Unlocking the Vault. The Intelligent Investor, by Benjamin Graham. When you think about investing, where do you start? For many, the journey begins with Benjamin Graham's timeless classic, The Intelligent Investor. This book isn't just a guide, it's the cornerstone of value investing. Benjamin Graham, often hailed as the father of value investing, offers a philosophy that is as practical today as it was when first published in 1949. What's value investing? Simply put, it's about finding stocks that are undervalued and selling for less than their intrinsic worth. Graham's strategy is about patience and discipline, avoiding hot stocks in favor of companies with solid fundamentals that are priced below their true value. He famously said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." This means that while market trends can drive prices up and down irrationally in the short term, ultimately, a company's actual value is recognized by the market. Did you know Warren Buffett, one of the most successful investors of all time, was a student of Graham? Buffett attributes much of his investment success to the principles he learned from The Intelligent Investor. In fact, he called it the best book on investing ever written. This endorsement alone underscores the book's impact. Graham introduces the concept of Mr. Market in this book. It's a hypothetical investor driven by panic, euphoria, and apathy, who you can buy from or sell to. This analogy teaches investors to remain focused on company performance rather than market fluctuations, an invaluable perspective for beginners. One of the most compelling aspects of Graham's approach is his emphasis on the margin of safety, a fundamental principle that involves investing with a safety net. This strategy reduces the risk of losing principal by insisting on a significant difference between a stock's price and its value. In the world of investing, knowledge is power. And by the end of The Intelligent Investor, you not only gain insights into picking stocks but also a philosophy that nurtures financial discipline and emotional resilience. It's a must-read that turns the novice into a savvy investor, equipped with tools to decode the complexities of the stock market. Chapter 2. Charting Success. A Random Walk Down Wall Street, by Burton Malkiel. Have you ever heard that flipping a coin might be as effective as a stockbroker in predicting the rise and fall of stocks? That's essentially the premise of Burton Malkiel's A Random Walk Down Wall Street. Malkiel argues that asset prices typically exhibit signs of a random walk and that one cannot consistently outperform market averages. The book demystifies the stock market for the average investor by explaining that the movements of stock prices are unpredictable and random. This is key for beginners who might believe they can predict or time the market. Malkiel uses statistics to reinforce his points, such as studies showing that active fund managers often fail to beat the market index. A Random Walk Down Wall Street is particularly famous for advocating an investment strategy focused on buying and holding index funds. Malkiel suggests that since beating the market is nearly impossible and costly, purchasing a broad market index fund is a smarter, more cost-effective strategy. He explains, a low-cost index fund is the most sensible equity investment for the great majority of investors. This book also introduces the concept of the efficient market hypothesis, which posits that stocks always trade at their fair value, making it impossible for investors to either purchase undervalued stocks or sell stocks for inflated prices. While this theory is contested, it's an essential concept for beginners to understand. Malkiel's work has not only educated countless investors but also influenced investment practices globally. As of 2020, more than $4.6 trillion was invested in index funds in the US alone, reflecting the book's profound impact on investment strategies. By the end of A Random Walk Down Wall Street, you'll likely view investing through a new lens. With its straightforward advice and emphasis on long-term strategies, Malkiel's guide is a beacon for those looking to navigate the chaotic seas of the stock market with confidence. Chapter 3. Profit from Patience. One Up on Wall Street, by Peter Lynch. If you're just stepping into the investment arena, Peter Lynch's One Up on Wall Street can act as your personal investment coach. Lynch, who managed the Magellan Fund at Fidelity Investments between 1977 and 1990, delivered a staggering average annual return of 29.2%. This book distills his wisdom into actionable advice for individual investors. Lynch's fundamental message is simple: invest in what you know. This empowering strategy suggests that ordinary investors have the upper hand because they can spot investment opportunities in their everyday lives before Wall Street can. For example, if you're a fan of a particular brand that's also a public company, and you see it growing in popularity, it might be worth investigating as an investment. The book is packed with straightforward strategies such as understanding a company's story before investing and recognizing long-term growth potential in boring stocks that consistently perform well. Lynch famously categorized stocks into 6 types: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays, each with a different potential for reward and risk, helping investors to diversify their portfolios effectively. Lynch also coined the term 10-bagger in this book, referring to an investment that appreciates to 10 times its initial purchase price. He shares numerous examples of how recognizing the potential of under-the-radar companies led to impressive returns. His approach encourages investors to stay grounded, do their homework, and invest for the long haul rather than seeking quick profits. Moreover, Lynch emphasizes the importance of ignoring the fluctuations of the stock market and focusing on company fundamentals. He advises, the key to making money in stocks is not to get scared out of them. By the end of One Up on Wall Street, you'll not only learn how to identify great investment opportunities but also understand the importance of patience and knowledge in achieving investment success. Chapter 4. The Millionaire Maker. The Little Book That Beats the Market, by Joel Greenblatt. Joel Greenblatt's The Little Book That Beats the Market is a masterpiece of investment strategy simplified for everyday investors. Greenblatt, a hedge fund manager and professor at Columbia Business School, introduces the magic formula investing, a method that promises to outperform the market by focusing on 2 simple criteria: price and quality. The magic formula involves buying good companies, high returns on capital, at bargain prices, high earnings yield. Greenblatt has back-tested this strategy over 17 years, showing that it can indeed turn the average investor into a successful one by simply following the formula. According to his findings, this method has led to annual returns of over 30% on average, which is substantially higher than the market average. Greenblatt uses clear, straightforward language to explain complex financial concepts, making it accessible for beginners. He argues that while the market may seem irrational in the short term, over the long term, it values companies fairly based on their earnings and growth potential, which his formula capitalizes on. The book also stresses the importance of consistency and discipline, advocating for a long-term investment horizon. Greenblatt's reassuring tone helps demystify the stock market's volatility. Buying good businesses at bargain prices is the secret to making lots of money. By the end of The Little Book That Beats the Market, you'll be equipped with a powerful, easy-to-use investing tool. It's designed to help you make smart investment choices without the stress of predicting market trends. Chapter 5. Bonds of Wealth. The Bond Book, by Annette Thau. Investing isn't just about stocks. Bonds are equally important, especially for those who seek a more stable investment. Annette Thau's The Bond Book is the ultimate guide for understanding everything about bonds, from the basics to more sophisticated strategies. Thau, a former municipal bond analyst at Chase Manhattan Bank, brings clarity to a topic that many investors find intimidating. Bonds might seem less glamorous than stocks, but they're a critical component of a well-diversified portfolio. They offer regular income, safety, and can buffer against stock market volatility. Thau explains that bonds are not just for the wealthy or retirees. They are for anyone looking to preserve and steadily grow their capital. One of the key takeaways from Thau is understanding the relationship between bond prices and interest rates. When one goes up, the other typically goes down. This inverse relationship is crucial for predicting how bonds will perform based on economic trends. Thau provides examples and charts to make this concept digestible for beginners. Moreover, the Bond Book outlines different types of bonds, such as municipal, corporate, and treasury bonds, each with its risk profile and tax implications. Thau emphasizes the importance of credit ratings, advising that investing in bonds with high credit ratings can significantly reduce the risk of default. Investors are also guided on how to build a bond ladder, a strategy that involves buying bonds with different maturities to manage interest rate risks and provide liquidity. Thau assures, a well-constructed bond ladder is like having a savings account, where you periodically receive your principal back either to reinvest or to use as needed. By the end of the bond book, you'll not only understand how bonds work but also how to effectively incorporate them into your investment strategy, ensuring a balanced approach to building wealth. Chapter 6. Risk and Return. Common Stocks and Uncommon Profits by Philip Fisher. Philip Fisher is one of the most influential investors of all time, and his book, Common Stocks and Uncommon Profits, continues to be a vital resource for investors aiming to find high-quality stocks. Fisher's philosophy extends beyond mere number crunching to include evaluating a company's management quality, its competitive advantages, and its growth potential. Fisher introduced the concept of scuttlebutt, or the process of gathering information from a variety of sources to gauge a company's potential. He believed that talking to suppliers, customers, and even competitors could provide crucial insights that are not apparent from financial statements alone. His famous 15 points to look for in a common stock offers a checklist for identifying promising companies. These points focus on aspects like the company's commitment to research and development, its sales organization's effectiveness, and its profit margins. Fisher's meticulous approach to selecting stocks involves looking for companies with potential for long-term growth, which he aptly summarizes: the best time to sell a stock is almost never. Fisher also stresses the importance of a long-term investment horizon and the virtue of patience. He famously quipped, "The stock market is filled with individuals who know the price of everything, but the value of nothing." This highlights his belief in understanding a company's intrinsic value rather than getting distracted by market volatility. By the end of Common Stocks and Uncommon Profits, you'll have a deeper understanding of what makes a company worth investing in and how to spot these opportunities before others do. Fisher's strategies empower investors to make informed decisions based on thorough research and forward thinking.